Thanks for signing up. Thanks for joining. Lovely to have everyone here today. I'm going to be presenting alongside my colleague, Gareth Garlick. He's our VP Technical Services. Today, we're going to focus mostly on the updated PEA for the Goldfields project that was announced 2 days ago with an exceptional set of results. So the company is really excited about that and look forward to taking everyone through in a bit of detail. We'll also talk a little about the company. Hope to everything wrapped up within about 30 minutes, including any questions. And if you do have any, please just put those in the chat box and we'll get those answered at the end for you. So we will be making some forward-looking statements. Please do refer to those on our corporate deck or on our website. So the big question is why now? And as a developer and positioning Fortune Bay as a developer in the gold space, we really offer leverage to the gold price. Everyone knows the macro picture, I think, is particularly the US debt levels. That's $37 trillion, which they need refinancing. And we're in the early stages of a rate cutting cycle that's going to be really good for gold. And that's amongst other factors like inflation, like the weaker dollar, geopolitical risks. So really strong fundamentals for gold in place. Many analysts, major banks calling for $4,000 before the year end, and things looking really strong in terms of advancing gold projects. Developers offer a lot of leverage to the gold price, and the NPVs and IRRs for those projects rise sharply with modest gold increases, and that's particularly the case for Goldfields, which is highly sensitive to gold price, and developers typically offer more torque than producers. Developers also offer re-rating. They typically trade at NAV discounts, and as one embarks through de-risking, permitting, and also resource growth, there's opportunity to unlock a lot of value. On the capital and M&A side, rising gold prices draws capital to developers. The capital normally flows to the producers first, and if we look at that chart on the top right, we'll see the GDX and the GDXJ there, showing just how mining companies have really started to re-rate recently, and that capital tends to flow to the miners or the producers first and then to the developers. So I believe we've yet to see that truly flow down to the developers. I think we're starting to see that, but I think there's a lot of opportunity still in stocks like ourselves. Producers are also under pressure to seek new reserves. We know there's continual reserve depletion, and although we've heard recently from the Denver Gold Forum that M&A activity in this cycle is going to be very disciplined, there's still a need for new projects, and particularly projects in good jurisdictions like we have in Saskatchewan. And the producers are going to seek advanced shovel-ready projects, and we're pushing Goldfields along that path potentially for a producing company. If we look at that chart on the bottom right, it's a little bit outdated, but it does show the general trend, which is still the case where we have depleting gold reserves from the producing companies. And although we're seeing some increases in exploration spend, discoveries are not keeping up with the reserve depletion rate. So there's going to be a need for new projects to come online. And I think in Canada in particular, there's a really good opportunity for a new set of gold mines to be built in this cycle. So developers are really sitting in that strategic sweet spot, a mix of resources, of growth through de-risking and exploration, and offering a realistic path to production, and really sit between the riskier explorers and those fully valued producers. So why Fortune Bay? We have two gold assets in Canada and in Mexico. The Goldfields project we'll talk around today. The Poma Rosa project in Mexico, it has a historical resource. It's shown there. It's around 1.7 million ounces, as well as some exceptional exploration potential across both epithermal systems, which offer additional gold upside in the shallow cover rocks, as well as a larger porphyry that sits at depth where we know there's potential for copper gold mineralization, which hasn't fully been tested yet. So across the board, the company has in both current and historical resources around 3 million ounces, and we've announced a set of plans to move those projects forward with a real focus on gold. We do have uranium projects as were picked up during tough times in the market. We've elected to option those out, and they're currently both being explored this fall through drilling programs as well as airborne survey. We retain upside in those projects through those options, and as well as generating some revenues, and all non-dilutive for the company. In terms of our model, what we're really offering is a per share leverage. And what we've done here is our gold projects, we're going to be self-funding, and that's because we see them as lower risk. And there's an opportunity to drive them up that Lassonde curve, which is shown here, fairly quickly. Our gold projects, obviously Goldfields and Poma Rosa. Our more risky, earlier stage projects that include our uranium assets at Mermac Strike in the Woods, those are obviously higher risk. They're more greenfields in nature. There's going to be some significant spend needed there over time. So it makes sense for us to have those funded through partners to take those through those early stages while we retain a stake in those projects, preserving upside for our shareholders. We have a disciplined cycle-aware approach, and this has been a testament of real patience for the company. These gold assets were spun out into Fortune Bay in 2014, and the company's been exceptionally deliberate with their share structure, not diluting shareholders. We still only have 58 million shares outstanding, and that's going to offer a lot of torque for us. We're aligning our capital now with this gold cycle to start spending money on the gold assets as the company re-rates and to drive the value higher. The uranium as well, we identified an opportunity early on in the cycle, began staking at low costs, and have put those projects into partners' hands now. They're being funded, and again, offering that additional upside on those projects. So we're going to turn to the updated preliminary economic assessment for the Goldfields project. And just an overview and key attributes. Firstly, it's in a historical mining area, the Uranium City area. That's seen gold production historically from our box deposit, a small amount, just 60,000 ounces, but also substantial uranium mining in the area. So it's an area that has infrastructure. It has a community that understands mining. The infrastructure includes a road, power, civil contractors in the town of Uranium City, as well as the municipal infrastructure, which is really beneficial to leverage off in terms of a future mine development. There's a commercial airport which can carry large aircraft. There's scheduled flights in and out of Uranium City a few days a week. And then there's barge and ice road access, which will be available for any heavy machinery or supplies needed for future mine development. What's important here is that this is not any different to how other mines operate in northern Saskatchewan. If you look at SSR's CB Santoy mine, it operates under a very similar set of logistics, and as well as the uranium mines. They're all fly-in, fly-out type operations, and that's what's envisaged here for the Goldfields project. Our permitting is well advanced. We have an approved EIS in place from 2008. That's been confirmed. It's still valid. They don't expire. What's typically needed because of the time lapse is some refreshing of the data. And that approved EIS is for an open pit mine just at the box deposit with a 5,000 ton per day mill. Our community relationships are established. We have an exploration agreement with the community representative that represents the First Nations and the municipalities. That was signed in 2022. That covers all our exploration activities with consent up to and including a definitive feasibility study. And of course, we're operating in a premier jurisdiction here. Saskatchewan ranks #1 in Canada and #7 globally for mining investment, according to the Fraser Institute. Diving straight into the economics for Goldfields, and it's been an exceptional set of economics, really robust and strong across a range of gold prices. It's highly sensitive to gold price, and obviously that being favorable as gold price has risen and looks to continue to rise higher. The base case here is based on $2,600 an ounce, and some people probably ask, well, why is it so low? And that's because, engineering firms like Osenko, who did our study, they tend to be very conservative. They like to look at trailing averages and not necessarily long-term prices. And so that was a reasonable base case to start the study. But the delta between that and where we sit with spot gold is significant. And we're in quite an unusual environment for these types of studies. But just as we move up to that spot price, which we used at the time, this was on Friday, of $3,650 an ounce, really exceptional economics, highlighted by that after-tax NPV of 1.25 billion Canadian dollars. And this is all supported by very modest capex requirements of around $300 million. Of course, that factors into all recent inflationary increases, but does also include a contingency of $51 million. The all-in sustaining costs for the operation are very competitive at $1,300 an ounce. And this is based on a throughput of just below 5,000 ton per day. We selected 4,950, which supports a 14-year mine life. And we're going to talk a little bit more about why this case was selected. The project performs well at various throughput cases. We've looked at a 7,500 ton per day per our previous PEA, 10,000 ton per day. The larger throughput cases do tend to produce higher economics, but we've strategically selected it because of the permitting advantages, being able to keep that in province and not trigger federal review. And we'll talk a little bit about that on a further slide. I'm going to hand over to Gareth at this stage.
Yeah, morning everyone. So we are obliged to note that we have a restated mineral resource estimate with an effective date of 11 September, but this really is just the same estimate as was provided in 2022. It's based on the same supporting data sets. It's just been updated to use a slightly lower cutoff grade. It's been changed from 0.3 grams a ton in 2022 to 0.28 grams a ton now, simply to reflect the higher current gold price environment. So this has slightly increased the total ounces and in hand has slightly lowered the average grade. The grade models as posted in the block models for Box and Athona are shown in the figures on the right-hand side there. The open pits that were designed in the PEA are shown in black to illustrate what portion of the resources are pulled into the mine plan in the study. And 97% of those resources are in the indicated category. So they can be converted into mineral reserves at a pre-feasibility level with no additional drilling required, which is great. In terms of the mineral resource estimate, an excellent level of comfort for us is that we have stope models of the historical underground mining that was carried out in the 1930s. And if you use these models to extract the mineral resources from our estimate and correct them for recovery in the mill, you get a really encouraging reconciliation there, giving a high level of confidence in our mineral resource estimate. Next slide. So our updated mine plan pulls in an additional 4 million tons of feed compared to 2022. It's pushing into deeper resources that are now feasible at a higher gold price. At an average grade of 1.2 grams a ton, Goldfields would produce almost 900,000 ounces of gold over a 14-year mine life. That's an increase of 60,000 ounces from 2022. The mine plan and mill feed summaries are shown below in the figures. These are entirely focused on accessing the highest grade material possible as early as possible and getting that through the mill, generating a very favorable grade and gold recovery profile in the first 4 years. Lower grade material mined during those first 4 years will be stockpiled for later processing, and the average grade will drop off in subsequent years as that lower grade material is pulled into the production stream. Moving on to the process plant. We're looking at a very simple standard whole ore leach with the design criteria based on metallurgical work done by SGS Lakefield in 2015. The ore is quite abrasive and hard, so we have a 3-stage crusher feeding into a ball mill with a subsequent gravity circuit that feeds a concentrate into an intensive leach reactor to recover about 25% of the gold. The gravity rejects are then fed to the cyanide leach and carbon recovery systems. It's a very standard process flow sheet that with a mill feed of just under 5,000 tons a day will recover an estimated 95.4% of the gold in total. The process and recovery numbers are fairly well constrained at this point, but there's actually good potential with additional higher confidence studies, which is what we'd have to do at a pre-feasibility level to improve on efficiencies, consumables, reagents, and such, as at this stage we've been forced to be fairly conservative on those parameters in the absence of more definitive information. Moving on to the site infrastructure. So this slide shows the proposed site layout. This is, of course, very similar to what was proposed in 2022. It's just scaled up for the larger scenario envisaged in the current PEA. We've been able to really take advantage of topographical features using the historical tailings facility as a waste rock facility, stockpiling additional waste from Athona right next to the Athona pit to reduce travel and operational costs, with the remainder of the waste from Box stored in the main tailings facility just to the north, not far. The tailings storage facility takes advantage of a natural valley feature and would be constructed in 2 phases to reduce upfront capex and push as much possible back to years, as much expenditure as possible back to years 3 and 4. There's also plenty of space nearby to the mill for ore stockpiling and management, letting us stockpile that early lower grade material for later in the mine life. I'll hand back to Dale here.
Yeah, so our plan here was really around an expedited path to production and not to have that federal permitting review be triggered by a throughput case of 5,000 ton per day or more. So we settled, not to be too cheeky, we settled on a 4,950 ton per day scenario designed to remain within provincial permitting. We're really going to be building upon the valid 2008 EIS. What's needed there for this PEA mine plan is to address 2 things. The one is the time lapse since 2008 EA work. Those data sets are quite old, and regulators will want to see that nothing in the baseline conditions has materially changed. So that's some of the work that's currently ongoing. And number 2, the changes in footprint. Obviously, we're looking at bringing Athona into production from year 1, as well as that larger waste rock and tailing storage facility Gareth has mentioned. So all this can be done building upon the existing data sets. We've got sort of 10 plus years of existing baseline data that's hugely advantageous, plus positive permitting precedent already for the project. Those baseline studies have been initiated. We've been doing aquatic as well as terrestrial studies through the late summer and fall. Those initial studies expected to finish up later this year, and that will prepare us for initial regulatory engagement in 2026. And that engagement's pretty key because at that point we'll be submitting a project description, which will trigger a duty to consult. It will also give us a better framework to estimate timelines for the project on the permitting side. We do know permitting is the critical path for the project. We think we can work through sort of pre-feas and feasibility quite quickly given the large amount of historical data sets. So it's important that we start that permitting now. On the community side, although that duty to consult will only be triggered potentially early next year, we've already started building those relationships, and that's really key. And this goes back to 2020 when we first started reactivating the project, and we culminated sort of our relationships with the communities into an exploration agreement in November 2022. It really formalizes what we've been doing already. And that agreement provides consent up to and including a definitive feasibility study. What will happen beyond that will it be an impact benefit agreement or an RBA. So negotiations toward that will start to commence fairly soon, and that agreement would need to be in place prior to construction of the project. On the project development side, we are starting that engagement. Our engagement to date has been around exploration, but project development engagement is key to start that early. As I said, the duty to consult hasn't been triggered, but we're looking to start early engagements starting in Q4 this year. We're already lining up meetings, and that's working with Indigenous nations as well as the local municipalities to talk around the design of the mine and start to get feedback on that. Just 2 nice photos at the bottom here. The one on the left, just the Uranium City Fishing Derby. That's an annual event held just outside Uranium City. It draws people from all the neighboring communities and a really strong tradition amongst the communities. And we are very privileged and pleased to help sponsor that event. And Gareth and I both took part and helped with the event itself. Just on the right, there's environmental crews arriving at that nice airstrip at Uranium City, about to start some of the terrestrial surveying. I'm going to hand to Gareth to talk about the key opportunities for Goldfields.
Yeah, sure. So this is the scenario we're looking at. So our PEA is a best fit industry standard approach to developing Goldfields. It's what we're planning around. It's what we're looking at further refining, optimizing, and improving at a pre-feasibility level. But we've also been actively looking at an alternative development scenario. Goldfields is a past producer, as Dale mentioned, with a valid EIS from 2008. That was approved for 5,000 tons a day at box only. So in review of SGS metallurgical data from 2015, we recognized that there's a scenario in which we could use a combination of gravity recovery and flotation to generate an extremely high grade combined composite that could be as high as 300 to 400 grams a ton in as low a mass pull as about 0.8% of the total ore mass. So with a recovery that could be as high as 90% of the total gold. So I need to emphasize this is not something that's properly constrained, but the data we have suggests that it is possible. And we need to do some more work to properly assess this. So we have actually collected a representative sample, and it's with SGS already, and we're looking at pinning down those numbers a little bit more robustly. But what this scenario would do, it would allow us to fast track Box into production, as we could conform very closely to the original EIS conditions. It would generate a very saleable pyrite concentrate that we could export by barge or ice road for sale. And this would hugely reduce the upfront capex for the project required to get it into production. It would shorten the development timeline as well, and would get a slightly smaller profile, but a slightly smaller project, but a much more profitable one into production very expediently with avenues to amend the process and include a Athona into the mine plan at a later date. On the resource growth and exploration side at Goldfields, we are planning a 2,000 to 3,000 meter drilling program for next year. And what that is going to look at, we're still really interested in carrying out some additional delineation in the deeper parts of Box. In 2021, we tracked some high-grade ore shoots down a structural trend and showed grades of 9 grams over 5 meters, 13 grams over 8 meters, 8 grams over 12 meters. These are grades that could easily be pulled into an underground mining scenario, but we would need to delineate and drill these out in more detail to properly evaluate them. There's a big gap in the drill coverage on the eastern side, the deep eastern side of the Box deposit is an untested gap in the drill coverage directly down dip from the main deposit. So this has still got to be drilled. We're planning to put a couple of holes in there to make sure we're not missing anything significant there. At Athona, there's clear potential in areas of skinny drill coverage to the southwest of the main body and in the West Mine granite, it's shown in blue in the figure, to delineate and pull additional near-surface ounces into the mine plan. There are also other regional occurrences that we're planning on testing with a careful number of strategically located holes to test internal grade continuity and untested structural trends. This is Frontier, Golden Pond, and the Triangle deposits. I'm losing the plot here. So this staged approach would put us in a very good position to evaluate how many ounces we could look at defining, the cost of doing so, and then make a decision on advancing these to the point where more drilling could define additional viable mineral resources to keep growing and improving the project. Back to Dale.
Yes, in terms of next steps, and these were outlined in our news release, obviously a PFS is recommended, by Ausenco, and we are starting to take steps toward that, which have started already. Proposed programs are across the range of typical engineering, environmental type studies, but importantly, those leverage extensive historical data sets. So we do have a lot of advanced data sets already to validate and to work off of. So we're looking at shortened timeframes and lower costs. One study that's already underway, it's a post-PEA waste rock characterization study. And obviously, we are planning for other de-risking studies to commence. In terms of that accelerated production alternative that Gareth mentioned, where we produce an on-site concentrate that we believe will be marketable, we obviously evaluating that under the existing permit framework, and we expect to expand that to cover blended samples as well as variability testing across the two deposits. Gareth mentioned the exploration drilling plan. We're looking at likely early next year to drill around 2,000 to 3,000 meters. We have the targets. We're yet to design the details of that program and pin an exact number of holes and budget to that, but there's certainly lots to be done, and those meters will have to be carefully allocated to demonstrate the resource growth potential, which is certainly there. On the permitting side, baseline studies are ongoing toward that regulatory engagement in 2026, and then continuing proactive community engagement under our existing agreement, but also starting that project development consultation beginning in later this year. So just sort of switching gears and wrapping up here, thanks everyone. But as we look at Fortune Bay and how we compare to aspiring peers in the PEA developer peers more specifically, we remain significantly undervalued. This chart's a little bit out of date. It was put together on Friday. Things are changing quickly in the space for everyone, as well as Fortune Bay, but just relatively shows how we compare to peers on a resource multiple. In other words, our enterprise value based on resources. It's a US dollar per ounce number there. And Fortune Bay, if you look at Goldfields only, based on today's market cap, Goldfields only is around a $30 an ounce. If you bring in Poma Rosa, for which we're planning to convert historical to current resources, that number drops to around $13 an ounce. So, and that's certainly in our plans to do, and work is underway to get that project moving as well. So we think we really well poised for re-rating. Very important to our story is our shares outstanding. Compared to the same set of PEA developers, we have the lowest share count by some margin. And that's what the advantage of that is, that you have fewer shares, you have more talk. And basically, as we add value to our enterprise, that's going to get amplified in our share price. So why invest? We are built for the cycle. We have the right share structure, only 58 million shares outstanding. It's going to give us more talk. We have the right assets, those 3 million ounces across our two projects. Goldfields really underpins our story. It's foundational. It's got that robust set of economics and still undervalued, we believe. Poma Rosa, putting current resources in place, and then lots of upside there. And then, of course, our uranium assets. It's a non-dilutive optionality for shareholders, and which are revenue generating, helping to cover G&A costs. We have the right plan, a lot of catalysts and news flow up ahead. At Goldfields, we look into that exploration and further de-risking, engineering and permitting, and showing the timeline to construction. Poma Rosa, converting current mineral resources, and some really exciting exploration, and a lot of targets lined up for that project already. And uranium exploration is ongoing, through the fall, like I mentioned. And we have the right team. We've put together a team that's built to execute and execute responsibly, from capital markets to our technical team, financial discipline, and some really strong governance. So we'll finish up there, and I'll turn to the questions here. So first question, are there any interested buyers for Goldfields? Is a sale possible now, or does management definitely want to wait until the permit and feasibility study are completed? Should we expect the permitting process to take around 2 to 3 years? There certainly are interested buyers. We've been talking to people on and off for a long period of time. For us as a company, we want to get the company re-rated, the project value, the intrinsic value properly recognized before we look to transact. People often base transactions, they look at market cap as the first indicator, which can make transacting quite difficult. So you said, it's potentially for sale, but we're looking to, and just back to our business model, we're looking to drive as much value out of the project for our shareholders as possible. But we're certainly open to discussions along the way. And turning to the second part of your question here, timing on permitting, will it take 2 to 3 years? I'm reluctant to give an exact timeline on that. That certainly it could be a scenario, but we will be able to provide that guidance once we've spoken to regulators in more detail. Of course, if we operate entirely under the existing EIS, that could be shortened substantially. Next question, with regards to the new PEA, the results were rather muted compared to the 2022 report, and gives an example of the IRR and the NPV. What were the main contributors to lost leverage? That's true. If one just extrapolated a line on our sensitivity charts from 2022, you might expect us to land higher here. Of course, there's been a massive amount of inflation since then. Across the board, it's around 30%, which is what's been built into our PEA, and that obviously has a big impact. Importantly, there's when getting quotes, certainly that's at a PEA level, but when getting quotes, and Asenco's done that from vendors who supply mining equipment, because of the inflationary environment, because of the gold price moving up so quickly, there tends to be somewhat overreach on pricing. Obviously, also these contractors make more money when the gold price is high and more people are desperate for machinery. So that all plays into the inflation-related costs that have been factored in. So those are certainly the main drivers there. The other driver is the production scenario, as I outlined earlier, is that we gone to a lower throughput. If we had kept it at 7,500 tonnes per day, you can produce better economics. But we're not trying to impress the market here. We're trying to derive a realistic production scenario that can be well executed within the shortest possible time frame on this project. And that's why we've strategically gone with the lower throughput case at 4,950, keep that permitting in province, and be able to move that project forward as quickly as possible. And that's certainly, in people looking to acquire assets, that's pretty much the first question, is when can they start construction? When do you expect to drill again in Mexico? Are all the agreements in place with the local community? So those agreements are being worked on at the moment. What I can say, it's on track. We've had some strong support from the community. It does take time. We haven't just adopted an approach of going in and trying to get an agreement as soon as possible. We haven't been funded yet for exploration there. So we've taken the approach of let's build strong, meaningful relationships. Those are relationships that are being reactivated from a long time ago. We have a really good team in place, and we've really focused on educational pieces around exploration, but also beyond. And it's important to lay that foundation for the future of the project, and that I believe we've done a good job down there with the community, and we're in the process of those negotiations. And nothing's done till anything's signed, but everything is on track and certainly looking positive to getting work started potentially later this year. Any updates on Poma Rosa social license? How discussions going? I think I've answered that. Also, could you address some of the concerns relating to Goldfields funding due to being a small deposit with no existing mill infrastructure? Well, the funding, I think this PEA demonstrates a robust set of funding fundamentals. If you look at the mine life, if you look at the CapEx ratio, if you look at the NPV to CapEx ratio, if you look at the free cash flow, if you look at the payback, I think the financing fundamentals are there. So, funding I can't speak to until you actually get the money, but certainly there's interest in the project, and I think this project's time is now, and we're certainly looking good on a number of fronts. If you look at all the fundamentals in place needed to execute on a mine plan, Goldfields has many of them and really checks the boxes. And I think that's it for questions. So I'd like to thank everyone for joining. Wonderful to have you all. I hope you enjoy the rest of your day. We will send out a recording if you want to forward it on to anyone else. And if you do have any more questions, please feel free to reach out. There's a function on our website where you can book a meeting with myself. Otherwise, feel free to call our office and ask any questions. So thanks for attending. Bye for now.